In this presentation, you will learn how to record depreciation in the following account. In the general journal, in your income statement, the profit and loss section, and the provision for depreciation account in your balance sheet. Okay, now the last week or earlier this week, we would have covered the causes of depreciation, and we saw a couple of videos on how to calculate the depreciation. So today we are looking at how to record it in the books. So after you finish calculating it, you must record it in your books. Before you begin to record anything, you must first have some data to record. Okay, so let's get some data. A business has a financial year end of 31st December. Okay, so that's when they close their books and they prepare financial statements, their income statements and their balance sheet. It brought a machine for 2000 on 1st January 2017. Show the depreciation records for the first 3 years using the reducing balance method at 20% per annum. Okay, now we deliberately choose the reducing balance method because it is the better method to illustrate with, since the balance changes every year. Okay, so we will do our depreciation schedule first thing, right? The depreciation schedule. Now, when you buy an asset, like you buy an asset on the 1st of January 2017, you don't wait to the end of the year to calculate depreciation. You do the depreciation schedule right away on the 1st of January. And that's part of your forward planning. Okay? And as a matter of fact, some businesses would do their depreciation schedule even before they buy the asset. Right? So it's part of their planning. And here we have the depreciation schedule using the reducing balance method at 20% per annum. So the cost of the machine on 1st of January is 2000. And from that, at the end of the year, 31st December, we will take the depreciation for 2017, 20% of the 2000 yearly cost. And we will get 4000. The net, that 400, and we will minus it from the 2000 to get the value at the end of the year. So after 1 year's use, our machine will now worth 1600, and that worth is called the net book value. Notice it is not the market value. The market value you can get a different price maybe for your machine than this year, but it is the value in your book. Okay. Now, when we get to the end of the next year, 2018, we will calculate another 20%. But this time it's not only 2000, but it's only 1600, the reduced balance. The balance has been reduced for depreciation in 2017, right? And we will get 20% of 1600, we get 320. Again, we minus it from the 1600, and we get 1280. This is, again, is the book value for the end of 2018. And then one more year we will do. We will minus the depreciation for 2019 when we get to the end of the year 2019, 20% by the 1280 here. And we get 256 minus the 256 and 1280, and we get 10,000, sorry, 1,024 as our net book value. So this is a new terminology you're learning here. It's called the net book value. Sometimes it is abbreviated NBV. Okay, so our depreciation schedule will continue on down as long as we keep the asset year after year. The reduced balance would be depreciated by a further 20%. Okay, so now let's see how we record this first in the journal. Right, you know, the general journal is the first one of the books of original entry. That's the first place we have to record our depreciation. So for 2017, we'll have a general journal for 2017. And I'll just bring this forward here so you can see where we are getting the figures from, just in case you have forgotten there. Our general journal would look something like this. For December 2017, we have a debit column and a credit column showing which accounts we are going to debit. The debit, right now, the amount that we are going to look at is the 400 here. That is for 2017. That is what we want to record in the account, the depreciation for that 400. And we will debit our profit and loss account with the 400 and credit a new account called provision for depreciation on machine. That's 400 as well. And we have to write a narrative depreciation for 2017 on machine. Okay, so we would have entered it in the general journal for 2017. Now, each year you have a separate general journal. When we get to the end of our financial year for 2017, this 2017 general journal would be closed off and you start a new one for 2018 when the depreciation for 2018 would be recorded. So let's take a look at that. So you have the general journal for 2018 here. And again, I bring this forward so you could see where the figures are coming from, what we just calculated. For 2018, the amount of depreciation we calculated or estimated is 320. So we get our general journal for 2018. So this is for 2018. And we have our debit column, our credit column. And again, the entry would be the same. Debit profit and loss account, this time is 320. And provision for depreciation, 320. And the depreciation of our machine on 2018. Okay, so notice the debit is in the same account and the credit is in the same account. All right, but we have new books for the new year, right? So we take a look at 2019. General journal for 2019. And the amount is 256. We get our new general journal for 2019 and profit and loss account is debited with 256 and provision for depreciation is 256 as well. And we will call that depreciation for 2019 on machine. Okay, so notice what you need to notice here is that for each of the 3 years, the same account was debited and credited. Okay, it's always the same. If it's another type of asset, say motor vehicles, the provision for depreciation would be on motor vehicles, and our narrative would read depreciation for whatever year on motor vehicles. So type of asset, uh, each type of non-current asset has their own provision for depreciation account. Okay, so this is a new account that you have learned here of. We have never seen that before. It means we are setting aside money for the loss in value for the depreciation, and we taking the money out of our profit and loss. So the loss in value of our asset is taken care of, accounted for. Okay, so let's take a look next at the income statement where we record the depreciation as well. Income statement for 2017. Each year you will have an income statement, and each year you will have to record your depreciation for your different assets in your income statement. We bring up the schedule again so you are reminded. Right, our profit and loss account. This is the second section of the income statement. As we saw last year, the profit and loss. You bring down the gross profit, right? So for 2017, we would bring down our gross profit in the profit and loss account from the trading account, and then we will put in our expenses. One of our expenses would be depreciation on machine 400, the 400 that we calculated here. Okay, so that's how you record it in your income statement, the profit and loss section here. All right, notice it's for 2017 only, not for the whole 3 years or more than 1 year. It's 1 year's charge of anything would go in the income statement. All right, let's take a look at 2018. You have the income statement for 2018. Again, we bring up the schedule here so we can get the balance here. It's 320 to record in our income statement. And we have the profit and loss account for the year ended. Again, our gross profit is brought down. And then we less our expenses. Depreciation will be one of the expense for 320. Our other expenses would come underneath, and then we'll add it up and get our total expenses, the minus from the gross profit to get our net profit. Okay, so this is how you record 2018. Then you move on to the next year, and 2019. We check our depreciation schedule for 2019, and we see the depreciation is 256. Go to our profit and loss account for the year 31st December 2019. Notice again, each year you have a different profit and loss and income statement, right? Bring down our gross profit, less expenses. Depreciation would be one of our expenses, 256. Okay, 256. and that takes care of our recording for the 3 years that we wanted to look at. And we will consider next the provision for depreciation. This is the new account that you open. Provision for depreciation account 31st December 2017. Right? It would look something like this. Let it finish right out. Right? We will debit the profit and loss account here with 400. Right? That's the entry from our general journal. And then we will carry down the balance when we balance the account. And we bring it forward in the 1st of January, the balance carried down and the balance put forward here. Right? Now, that would take care of December 2017 for the depreciation provision for depreciation account. So we look at 2018. And let's let it type out. Right. Now this 2018 begins here, right? So what happens, and we still have 2017 up here, the 400, right? So this is an account that is carried forward from year to year in our balance sheet, right? It's what we call a contra asset account. And if you notice, this has a credit balance in it, all right? This would be the this would be minus from the relevant asset account in our balance sheet. Okay, we look at that in another time, and so we bring down the balance from last year here. No, this is on the opposite side, so it comes in here, and then we have this year's charge 320. Okay, then we add it, bring across the total. Total comes at the top here as our balance carried down, and we bring it down here. Okay, so that's how we record the provision for depreciation in the second year. The third year would be the same thing. So we will bring the lesson to a close here. And although it looks brief, it covers quite a lot. So I didn't push into the balance sheet. This is enough for one day. What I wanted to do is practice this. The exercise that is up in the classroom where you have uh, depreciation schedule to do. I wanted to take that and you will write up a income statement and your provision for depreciation account as well as the general journal for each one of the years. Okay, we have to practice this in order to become very good at it because adjustments to fixed assets is one of the most important things that you have in your accounting. Uh, Non-current assets carry sometimes the biggest value that you have on your balance sheet, and therefore you have to pay particular attention to getting a correct estimate of their value. Okay,